Bob, of course, we just have to start off here on the rise that we're seeing in rates here. And really, I guess what everyone wants to know is 5% or 6% or wherever mortgage rates end up here on average. Is that going to be a deterrent, a significant deterrent to home buyers?
Good afternoon, Romaine. Thanks for having me. And I think that we are about at the end of the increase in mortgage rates. We've seen the mortgage rates go up over 150 basis points just this calendar year. And we think that they are anticipating the full range of Fed movements. So we think that the rates are going to not go much above 5. But even at that level, to your question, of course, it does make the monthly payments higher, which means that people will have a little more trouble qualifying for a mortgage or will have to take a little bit lower mortgage amount. So it's certainly a headwind, but it's also a necessary step as we have seen really unsustainable home price appreciation in the high teens year over year for a couple of years running. So there is a need to cool things down a little bit in the market with such an imbalance of supply and demand.
It was interesting. Of course, Romaine was just coming off of the commodity close. We've talked a lot about lumber, even the labor supply in the market. As you think about sort of not only just mortgages, but the broader economics, the other inflationary pressures, the other supply chain issues within the market, have those started to normalize as well?
Unfortunately, not really. I think you've seen some improvement in the commodity price, but I think it's still the case that whether you're trying to build a home or even if you're just trying to do an addition or a remodeling, you're really still seeing shortages, delays, and higher prices pretty much across the board. And as you mentioned, even if you can get the materials in, you have to get a skilled tradesman in to help you install them. And that's all really, it's still at a premium.
You know, we've had JP Morgan warning about mortgage rates for about a year and what it would mean for new originations. And with what you're saying about kind of a plateau here in rates, are we going to see that create many more new originations given that there is some stability here rather than straight rises?
Well, this is a little bit of the best of times and the worst of times in the mortgage world because we're coming off a record year of $4 trillion in originations. And while we're going to see a 35% drop, we think, that'll still leave us at about $2.6 trillion, which is the fourth highest on record. So, of course, the difference is the refinances are going away or dropping by about 2/3, while purchases are actually going to be up about 4%. So there is still this great demand for housing. And while there's, of course, an inventory problem, one reason that people see so few homes on the market is because they get snapped up so quickly. So it doesn't mean transactions aren't occurring. It just means they're occurring so quickly and many times with multiple offers that it's hard to get in on a home sometimes. But we're still going to see, we think, 6.1 million existing home sales, which is about as high as we've seen, and certainly the mortgages associated with it will be a new record.
Well, talk a little bit more about how much refinancings were critical to some of your member companies here. For some of us of a certain age, I mean, when we came kind of into adulthood, I mean, we were still kind of looking at double-digit mortgage rates. Even if you had good credit, you were paying 9, 10, maybe even 11% here for a mortgage. There's been just a straight down-step pattern where if you bought a house in the 90s or in the 2000s, you can refinance over and over and over again till you got down into the 2% range, assuming you were able to do that. That had to have been a big boost for a lot of these refinancing businesses. And I'm wondering what happens to those businesses if we are in a prolonged trend here of interest rates rising.
Yes, well, the members of the Mortgage Bankers Association, I think, did a great job of getting the stimulus from the pandemic in the form of lower rates put forth by the Fed into consumers' pocketbooks in the way of rate and term refinances and getting a lot of people into situations where they probably won't have to refinance again for quite some time, if ever, unless they want to do cash out, which is much more available now with the high equity that most people have in their homes. But yes, certainly as it relates to our members, those who relied on refinance business, of course, are going to have to retool, probably shed some capacity, because absent cash out refinances and maybe some home equity loans, particularly with the depository institutions, people are going to be reluctant to refinance out of a 2.5% or 3% mortgage to get into a higher rate. So certainly the purchase business is where the spotlight will be for our members.
How is your industry bracing for QT, a dislocated mortgage-backed security market, as you have a Federal Reserve looking at, well, either a passive roll-off of mortgage-backed securities on the balance sheet or maybe active selling?
Yes, well, that's certainly added to the volatility of rates, is the uncertainty with how the Fed responds, both, and as you say, just letting them passively roll off or even potentially selling some of their holdings. We're not worried about there being a demand in the market for mortgage-backed securities from private actors, but clearly with the Fed having vacuumed up such a large supply of MBS, it does contribute to the volatility of rates. So again, we're not concerned about demand. It just will affect the price at which these MBS trade, which ultimately is factored into the mortgage rates.